as long as they're financial. 888-99-CHART is our number, 888-992-4278. Okay, let's go ahead and start with our first caller. Let's go to Eric in New Jersey. Hi, Eric.
Hi, Steve. How you doing?
I'm good, and I thank you for the call.
My question today, Steve, is regarding a 457B plan that I have. Mm-hmm. I'm a police officer in New Jersey, and I've been on for about 11 years. I got quite a few more years to go before I retire, so I could, I guess, afford to be riskier with that account. But the reason I'm calling is for about the last year or so, I've been paying into a fixed account that's getting me 3.75% a year due to all the volatility and everything with the market, and I didn't really want to be losing money. So just seemed like a sound idea at the time. And I'm thinking about getting back in, and I was just speaking with my advisor who runs the account through MetLife, and I'm trying to decide kind of what I want to do with that account, whether I want to get back in the market entirely with what I have, which is like $68,000 at this point, $20,000 of which is all profit, whether I want to go back in entirely or just take what I have as profit, put that back in the market, or stay in the fixed account and just take my 3.75% and ride out any perhaps volatility or if we are in a bubble, the tech bubble, is AI bubble that's going to pop at some point.
Can I ask you what are you invested in? I know it's a fixed income, but what kind? What is it? Is it bonds? Is it a money market fund? What is it?
It's like a money market, more or less. Yeah.
Okay, so because my answer would be different if you'd said anything but a money market. If you said it was some type of bond fund, short-term, mid-term, or long-term bond fund, I would suggest that don't get out of it quickly. Get out of it slowly, because I think interest rates are peaking. I think we'll have maybe one more increase, maybe two, but I don't think so. But then we'll have a long period of flat, and then the next move will be down. Interest rates moving down. And when that happens, bond funds go up in value, so you get your 3.7 plus capital appreciation. But money market fund probably won't do that. So my answer is I think you should start teasing back into the market. I wouldn't dump all the money in it right away. I would dollar cost average probably through the $68,000, and by maybe the end of the year, the beginning of next year, have all that $68,000 in the market. And I would diversify it in market cap, small, mid, and large cap. I would diversify it. But don't do it all at one time, though, okay? Eric, I appreciate it.
Do you have questions about FDIC security, mortgages, money market funds, losses to your retirement plans? Give us a call today, 888-99-CHART.
My name is Randy from Iowa. I'm currently in Illinois because I'm a truck driver, and that's the issue. I don't have a lot of time each day to study and dig in like I know is necessary to really understand. Your program has helped a lot, but my question is this basically. If you were in the situation of not working in the field you do, in other words, if you were not a professional investment advisor and were limited on time, how would you pare it down? What are the very minimum basic things that you would want to study to understand before making a stock investment? I know there's a lot of factors, and you do this professionally, but if you were not in your current career, you were in some other career where a lot of demands were on your time and you didn't have the kind of time to really dig in, what were the minimum factors that you would want to look at and understand before investing in a company? Thank you, and you have a great show. Keep it up.
There'll be two things you need to know. First, from a macro, and micro. Macro, you kind of have to understand the environment you're in, the interest rate environment, the economic cycle that you're in. Where are we in that cycle? So, and I'm not going into details about that, but you kind of understand what the cycle is economically and interest rates. Okay, right now we're kind of having a high cycle on interest rates, right? And we're on a slowly downward cycle on the economy, but not very deep so far. Okay, then from a micro point of view, you look at stocks. that do well in a rising interest rates environment or a high interest rate environment, and stocks who do poorly in that. And there are charts on the internet. All you do is type in search for economic and stock market cycles, and you'll see that the stock market moves up prior to the economic cycle moving up from a low. And you'll see that the stock market starts to move down when the economic cycle is high. Okay? So wasn't the economic cycle high before they started raising interest rates? Yes, it was. Okay? It's not even that there wasn't that much damage done to it so far, even though they rose interest rates. So from a company point of view, you have to also understand value stocks versus growth stocks. And when's a good time? Yeah, it's a bad time to buy value stocks when interest rates are very, very low. That's a time to buy growth. It's vice versa. Now, from an individual company point of view, you want to, in this environment, buy good value stocks that are not too expensive with PE ratios, and therefore you need to know what the average PE ratio for every average industry. These are basic things that you kind of have to know. And once you know them, it's not hard to know them. Once you know them, you'll be a much better investor. You also can just buy index funds, buy them, hold them, and just ignore everything else. You can do that. You've got to hold them for 10 years plus, 10 years or more. You can do that, and you'll be successful. You can call right now and be part of the program. Let's hear about what your talking point is. 888-99-CHART, 888-992-4278, and you can get through right now.
When listener questions are played on the InvestTalk podcast,
how do you guys determine a value stock?
The caller voices are amplified many thousands of times.
Just wanted to get your opinion on JP Morgan and BAC.
How do you see this looking forward?
I'm 25 years old and have a question about retirement funds.
And the unbiased answers from Justin Klein.
That's why it's trading so cheap, because there's a lot of regulatory risk here.
And Steve Peasley.
I kind of like it here. If I was going to buy Tyson Foods, this is where I'd buy it.
Benefit the entire InvestTalk community.
Thank you for what you guys do.
That's why 24/7, rain or shine, no matter how simple or how complex, your questions make a difference.
Symbol BKE. What's your outlook?
And InvestTalk is made better by the power of you. So don't forget to call 888-99-CHART.
You're listening to an encore presentation of InvestTalk. Please call with your questions and comments, though, 888-99-CHART, 888-99-CHART, and Steve will answer them on the next InvestTalk.
Let's go to James in New York. He wants to talk about mortgages.
Yes, I currently have about 25 years left on my mortgage at a 2.9% interest rate. And I was wondering if I were to pay the remainder of the mortgage off now, if I had the means to do that, would that be advisable during this climate, saving 25 years worth of interest, or would I be better serviced investing that money?
Right now, you would want to be putting that money into something very safe, short-term treasuries, right? You're accruing interest on the mortgage that you have, but you'd accrue more interest in putting whatever money you would put towards that mortgage in something like short-term treasuries. You yield 5%. So you're actually risk-free, basically, earning more than you're being charged on your mortgage. So until mortgage rates treasury rates go below that number, it would make no sense to pay down that mortgage, because you're easily, with no risk, earning more than the cost of that mortgage. So no, it wouldn't make sense. Now, once again, if one day the Fed cuts rates again and we're back down to 2% short-term treasuries, now you have another conversation. You are now costing yourself more than what you'll earn on your investments. So at that rate, no, it doesn't make sense to pay off that mortgage right now. Could it eventually? Sure. Depends on your risk tolerance. It's obviously it's a conservative decision to pay down a mortgage, especially at a rate that low. Does that make sense?
Oh, definitely. Yeah, I knew I had a low mortgage. It was just a issue of the security decision to pay it off. But I absolutely don't have to. But it was just a thought. But
yeah, and I get that thought. And there's a lot of people that security makes sense. But as long as what you're investing in is very low risk, like treasuries, and you're making that spread, then it makes zero sense to pay off the mortgage. And a lot of people are in this in this bucket where they might have extra cash and typically they might pay down that mortgage, but right now it just doesn't make sense. I mean, you can go put your money in a high yield savings account and treasuries and so many different assets that are yielding 4 to 5% that it's just pointless to be paying down a mortgage at this time. And a year from now, that might change. But right now, no. Thanks for the call.
Do you have questions about FDIC security, mortgages, money market funds, losses to your retirement plans? Give us a call today, 888-99-CHART.
Hello, this is Tori from Bozeman, Montana. I'm calling to ask about a refinance that I'm currently in the middle of. So I'm refinancing a rental property that I own. And I was wondering, because I do have a good bit of equity in that property, and I haven't quite been maximizing my Roth contribution every year. So would it be smart to take some of that equity out of my house and actually just put it into my Roth IRA, where I feel like it can make better returns and possibly beat what my home might be able to bring in terms of equity in the future? Look forward to hearing your answer. Thanks so much. Bye.
Well, when you refinance, it's a good question. When you refinance, how much does that cost? What is the cost of the loan when you refinance? Because it always boils down, everybody, to the best use of your money. What is the best use? And he's saying, well, maybe I have a better use of my money out of the real estate and into my Roth. Okay, because the Roth gets to grow tax-free, but my house, when I sell it, I'm going to have to pay capital gains on the gain of that house, even though but then again, I'm earning rent every month, and how much is that? So how do you make that decision? For me, it would be, if I take money out of my house, am I cash positive on a monthly basis with the rental property? Because I don't like to be cash negative and then maybe be forced to sell the property down the road because I got to keep putting money into it. And I'm now stuck selling at the very worst time to sell real estate. But if you have cash flow positive, that means you're making money all the time. You can put a bunch of that aside and put the keep on the house and pay the taxes and whatever else you need to pay, and you're never forced to sell the property. So I would suggest, I like maxing out your Roth a lot. So maybe do that math. Is it because if you do invest in Roth, you can say if you buy an index fund, the chances of a 9% return per year are high if you have enough years to let it run, 10, 15, 20 years. If you're close to retirement, you only have 3 years, then maybe it's not so smart to put money in the Roth and take it out of the rental property. See, it's not that easy of a question. It's not you just go, okay, this is the answer. I wish it was. We need we got to do some math. And it's not hard math, but we got to do the math. So it could be a good thing. I do like maxing out your Roth. And taking out of your property may not be a bad place to do it, especially if the property is not gaining in value. Is it in the area? You're in Bozeman, Montana. Montana values have been going up, if that's where your property is. By the way, I'm going fishing there for a week next year, somewhere in Montana. I'm looking forward to it a lot. Beautiful country out there. You're listening to InvestTalk, everybody. I'm Steve Peasley. We want to answer your questions. Our listener line number is always ready for you, 888-99-CHART. Beginning our experience, we're here to answer your question.
You're listening to an encore presentation of InvestTalk. Please call with your questions and comments, though, 888-99-CHART, 888-99-CHART, and Steve will answer them on the next InvestTalk.
Let's go to Paul in San Francisco. Let's talk with national debt.
Yeah, we're getting close to the limit of the national debt, which is over $31 trillion. And will that happen? Will we see that? Didn't that happen before? Some of these earlier? According to my memory, it did, but it comes out wrong. And Biden just wants to spend money and print money and spend money and print money, and that causes inflation. Inflation is a tax on the middle class and the poor, but not the wealthy.
Well, this is a situation that has been years in the making, right? So it's definitely both sides of the aisle. They all want to spend on their pet projects. This debt ceiling issue is something that I've been hearing about for, pretty much my entire career, over 20 years. I've heard this many times. There's a lot of political brinksmanship here that is ultimately not going to amount to, I don't think it's really, I think it's more headlines than anything else. The decision to spend money, it happens when you talk about budgets, and that includes spending, but also taxing, right? So under every administration, the debt's gone up, really, except for I think the Clinton administration, the very end of the 90s, because of demographic issues or not issues, but tailwinds, shall we say, and a strong tech sector. We had a surplus for a short period of time, but that was pretty much it. So you can't really blame one side or the other. They're both very culpable in this. And if you are blaming one side or the other, well, you're using your politics to do that.
Hi, Steve and Justin. Love the show. Appreciate all your advice. I have a question about timing the market. So time in the market, not timing the market, is one of the most important things when investing. And I hear you say not to chase returns. However, many of your callers ask when is a good time to buy a certain stock. So in other words, buying on the dip maybe. So my question is, how can you reconcile these two seemingly conflicting ideas? If a company has a strong business model and strong fundamentals, et cetera, why would I wait for a dip that may or may not happen? So appreciate the show again, and my name is Forrest, and I'm from Michigan. Thanks a lot, guys. Bye-bye.
Well, Forrest, you actually have a very good point there. You're correct. There's, what's the difference when I say, well, wait for that dip or let the dip happen or it'll probably come back down. What I'm looking at when I'm talking about those things and when Justin and I are talking about, we're looking at a chart and just looking at the past pattern of trading of that stock. We also might be looking at the fundamentals, current fundamentals of that company and saying it looks like it's going to go into a weak period in their earnings or sales and we should get a pullback versus trying to time the market in and out of a stock or in and out of stocks, period. Many people, I'm just looking for a good buy point. And some stocks, you just buy it. I'll give you, for instance, maybe you should just buy Apple. Not that I'm suggesting to buy Apple, but I'm thinking, some stocks you just buy and don't worry about it too much, as long as you have a long-term horizon. So you do have a point. We're not trying to time the market. We're just looking for a good entry point or exit point based on chart patterns. And chart patterns are not science. It's more of an art. So it's, if you're going to talk to me about being an investor, you're just looking for a good place to get in with a good price and just hold on to it. That's best, staying in the good, solid companies. But you got to buy the great fundamental companies, the fund companies that can support growth going forward and the price that the stock is currently trading at. 888-99-CHART is our number. I'd love to hear from you.
Hello, InvestTalk. I had a question about 401k allocation. I work for Kroger, and I'm limited with the options as far as what I can contribute to. So, there's an S&P fund, there's a fund where there's some small, mid, and large cap stocks in the U.S., a foreign fund, and then a bond fund in Kroger as an option. So those are my 5 options. And I'm 27, and I have about a 10% position in Kroger. The rest spread out between the options I just listed. My question is, if these are my options, is Kroger something that you would think would be good to have a 10% bigger or smaller contribution? Like I said, I'm 27 and plan on staying with them for a while. So I was just curious to see what you thought of that company and that allocation. Looking forward to the answer on the podcast. Thanks as always, guys. Bye.
Kroger is a grocery store company, and they are very slow growth, not a lot of profits. No grocery company does make a lot of money, and you're not going to make a big return on that. So definitely don't increase it. I would probably decrease it. I don't know if you get free shares or something or whatever. They give you a discount. I don't know about those things. If they did, then okay. But I don't think it's a long-term that great of a place to invest your money. You're only 27, so I'd split the money up between small, mid, and large cap funds. Okay, I would put a third if at 27 years old, so I can have exposure to small cap and mid cap where you get most of your growth long term. And the large cap S&P gives you some stability. But being in the stock market is risky. But being 27, you have decades to keep your money invested, and therefore you will do much better spreading it out in those three sectors than this being having Kroger. All right, if you buy one, like if you put all your money in the small cap, way volatile. That's very volatile. You might make a lot of money, but you could also lose a lot of money, and it might be at the very wrong time that you can afford to lose it when you're approaching retirement. So I'd spread it out. You can call right now and be part of the program. Let's hear about what your talking point is. 888-99-CHART, 888-992-4278, and you can get through right now.
This message is sponsored by Greenlight, the debit card and money app made for families. If you are a parent, have you noticed that as you are online, you may often see ads for various parenting hacks? In other words, quick solutions to tricky problems. Some hacks may be good ideas, others maybe not. Well, if you are committed to raising children that are made smarter and stronger by learning about financial responsibility, I encourage you to check out Greenlight. You see, as a debit card and money app made for families, Greenlight gives kids and teens an easy and fun way to gain financial literacy while providing peace of mind for parents. With Greenlight, you can send instant money transfers, automate your kids' allowance, and keep an eye on their spending with real-time notifications. Meanwhile, your kids can begin their journey towards financial autonomy by learning how to save, invest, and spend wisely. The Greenlight app includes a chores feature, so you can set up recurring or one-time tasks that are customized to your family's needs, and then reward your young ones for a job well done. Since 2017, Greenlight has helped more than 6 million parents and kids manage their finances. In fact, with Greenlight tools, families can even learn to invest together. Sign up today for Greenlight, the debit card and money app made for families, and get your first month free when you go to greenlight.com/investtalk. That's greenlight.com/investtalk to try Greenlight for free. greenlight.com/investtalk.
You're listening to an encore presentation of InvestTalk. Please call with your questions and comments, though, 888-99-CHART, 888-99-CHART, and Steve will answer them on the next InvestTalk.
Hello, this is Randy, the truck driver from Iowa. Now I'm in Illinois today. I have a question. Some time back, a year or two ago, I heard you talk about dividend reinvesting, and that rather than let the dividends go back into the company for reinvestment, to hold it in your sweep account, and therefore you could choose where you wanted it to go. I'm curious, is that still how you feel, or is it better to just let it be reinvested back into the company? For example, 3M pays, I forget the percentage, but it comes out to be $1.50 a quarter, $6 a year. Should I just let that go back into 3M, or should I let that collect with my other dividend-paying companies' amounts and then selectively pick stocks to either purchase or to invest in at that time, or to build out the positions in the other stocks? You have a great show. I have learned a whole bunch, even though I still don't know hardly anything. Thank you very much, and keep up the good work.
Well, that's a tough question, only in the sense that, it's easy to make the decision, but do you need more shares in 3M, for instance? You mentioned 3M, so let's talk about 3M. So if you have a good portion of your portfolio, and remember, we like 3 to 5%, and then if it grows more and more and more, then you would rebalance it downward, cut some of it. But if you don't have 3 to 5%, then you maybe want more shares, especially if the price keeps coming down. I don't necessarily like to reinvest my dividends in a stock that's going down, 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 down. I'd rather reinvest my dividends in shares of the company of the stock going up. And 3M has been falling pretty hard, but 3M is also a huge blue chip company, $54 billion in size, paying a 6.1% dividend, and it can afford to pay that 6.1% dividend. And even though sales have been slowly coming down in the recent 4 quarters, it's a tough question. Do you have enough dividend-paying stocks in your portfolio? Therefore, you maybe need to buy more of them. If you have plenty of them, then maybe you want them to reinvest in the company. So it's not just a straight yes or no answer. It really depends on your portfolio and the strategy you're trying to develop. Sounds like you're trying to develop a dividend-paying strategy, which is nothing wrong with that. I know Warren Buffett lets the dividends reinvest many times in the company he owns. I know that, but not always. So it's up to you. Okay.
Let's go to Andrew in Utah. He wants to talk about the market.
I've been kind of caught on the wrong side of this tech rally. I have the inverse of the QQQ, and I tried to get in on a short with Tesla, and then obviously it's been going up. Just wanted to get your thoughts on, what the play is from here. Do you think there might be a reversal, or, when the liquidity concerns after this debt ceiling kind of calms down, do you think there's going to be a reversal on these tech plays, or should I just cut my losses and get out?
Well, I don't think this is an environment that you want to be shorting tech, at least in the short term. Now, long term, I do think many of those are overvalued. But with interest rates coming down, that's really what you've seen, right? And this is really the main driver of where you've seen those multiples re-expand. You saw interest rates really explode higher to the upside all of last year, and they peaked out in the fall. And coincidentally, you kind of had the broader market bottom around that time as well, and the tech stocks really take off after all of that tax loss selling pressure abated in the fourth quarter. You saw that move to the upside. So in a lot of ways, these are long duration assets. Right, Luke? And that means that if interest rates are trending lower, which the 10-year peaked out around 4.3, now we're at 3.6. It's got as low as about 3.25. And the Fed is likely to be near the end of the rate hiking cycle. It's hard to time exactly when this rally is going to peak out. And it can be supercharged when you have a narrative shift like we have with AI.
Yeah, and I think that something that goes along with it is people are tending to invest in tech right now because they don't see a lot of opportunities in the real economy. Yeah. I think people are seeing a lot of traditional asset classes slowing down, and they're reaching for something, like you said, that has had this massive narrative around it, and I don't really see that narrative abating anytime in the short term. Again, in the long term, I think you're going to have some reversion. You see a company like NVIDIA that is trading at over 60 times its sales. Is that high? I think so. I think a lot of people would say that's high for any company, but I think in the short term, what you're going to see is probably some more fuel around this fire.
Yeah, and from a timing perspective, I think it will be when the market starts to realize that the economy is no longer slowing, it's reaccelerating. And I think that's first going to take a Fed pause, because obviously hawkish monetary policy leads to a slower economy. And you've seen that. But as we talked about at the top of the show, the fact that the economic data is finally showing what the market has been pricing in for some time, that, hey, the economy is now no longer growing very strong, and it doesn't make sense to raise rates. In fact, the next move for the Fed, I think, is likely lower. It usually takes there's usually a 5-month on average span between when the Fed pauses and when it actually goes into cutting mode. And so we could have that by the end of the year. So when exactly will that be? I think it will be probably when the Fed first makes its first rate cut. I think that's probably when you'll see really that shift to back to the real economy stocks. And that's probably coming up sooner in my mind rather than later.
This is InvestTalk, made possible by KPP Financial, where principals and InvestTalk hosts Steve Peasley and Justin Klein are independent financial advisors. For clients, they are fiduciaries. Steve and Justin have a duty and a commitment to always place the interests of their clients ahead of the firm. This is different from the way many other organizations operate. And one way you can realize the benefit of an association with KPP Financial is to know that KPP practices parallel investing. This means that the personal investment accounts of KPP principals participate with client investments at equal prices and percentages. It's an important difference. You can learn more anytime at investtalk.com. Or reach out to Steve Peasley and Justin Klein by emailing or calling their Irvine, California office. The InvestTalk radio and podcast continues now. The phone lines are open. Call with questions, 888-99-CHART.
Let's go to Gene. He's in North Carolina and wants to talk about credit unions.
Yes, thank you for taking my call, Justin. And you have Luke with you today, right?
We do.
That's great to hear that once a week you get a Cornell man in there on the podcast.
It's good to have him.
Getting to my question about credit unions, a general question about personal finance. We have a choice in doing our banking, whether it's a regional bank, a big national bank, or credit unions. And I've used the credit union as the primary source to do my online banking and my local banking and using debit cards and so forth. I'm wondering, do you and Luke have any opinion about using credit unions? My understanding is that some credit unions, I originally started using it just so that I wouldn't get dinged with little junk fees that banks sometimes give you.
Mm-hmm.
And a lot of them, those junk fees went away with no minimums and so forth. In general, I heard that some credit unions, they kind of specialize possibly in auto loans, or each one is kind of specialized in their own little niche of what they're good at. But I wonder yours and Luke's general opinion about credit unions.
Well, I actually, my personal banking is with a credit union, and our corporate is with a large commercial bank. So I kind of have both experiences. I see no problem using a credit union. You're right that some are good for certain reasons. I think in today's day and age, where with FDIC insurance and credit union has its own deposit insurance, it's really what's right for you, what your needs are from a branch perspective and a product perspective. And you're right, some are good auto loans. I know mine, we get very cheap. I get offers for, I used to anyway, 1% auto loans all the time. I don't know what they are now, but you're right. Luke, do you have a comment on that?
No, yeah. Personally, I used a credit union to finance my car when I bought my car. I think one of the reasons why people use credit unions in the first place was because they have less overhead. They're cheaper. They tended to offer higher savings rates, right? Mm-hmm. But I think a lot of the reason why people stray away from banks now, there's a lot of more availability outside of credit unions for saving rates that are really high. So I think that's kind of taken a back burner. But certainly for financing purchases, I think it's a great option.
Yeah. Like you said, there's more alternatives now than there used to be for your banking, right? Your Marcuses of the world, your Ally Bank, et cetera, that are online banks. So I think there are some better alternatives, but to each their own. I think they all have their pros and cons.
Do you have questions about FDIC security, mortgages, money market funds, losses to your retirement plans? Give us a call today, 888-99-CHART.
Well, let's grab a voice bank question that came in earlier from Germany on 888-99-CHART.
Hello, Steve and Justin. This is Paulo from Germany calling. Today I have a question about portfolio management, and it's actually a question about which is the perfect or a good allocation, like considering the market cap. Right now I'm invested like in 28% in mega cap, 41% in big cap, and mid cap 15%, small cap 10%. So I was thinking, and I'm trying to get more into smaller and mid caps and cutting my mega caps, because I think there might be more growth in small and mid-cap names. So, yeah, my question is basically, how do you guys allocate considering market capitalization? Okay, I'm looking forward to hear the answer on the podcast, and thank you so much for all the work you guys do. Bye-bye.
All right, it's a great question. That's something that most people don't think about, right? They just buy names and they look more about the sector and not just about the size of the companies that they're investing in. Now, right now, the better values are in those smaller cap names, but they're also higher risk. You've seen that this year, right? Mega caps have outperformed those smaller caps. So, but does that mean that's going to be long term? Well, the valuations say that small caps are going to be better performers in long term. Small and mid caps tend to outperform large caps, but that's obviously not every year.
Yeah, it's kind of a risk tolerance story, right? Because the only reason why the small and mid caps tend to outperform in the long run is because you're taking on additional risk. Mm-hmm. So without knowing, personally what your risk tolerance is, it's difficult to say what an adequate allocation should be.
Yeah, exactly. It's hard to say just now. And looking at that breakdown, my natural instinct, you sound like a younger caller, would be, yeah, you probably want to trim some of those mega cap names, especially, and invest in some of those more mid and small cap names. Now, of the different market cap buckets, shall you say, typically mid caps have the best risk versus reward, right? The small caps, they tend to, some of them go bust. They're small for a reason. And the mid caps have still room for a lot of growth, whereas those mega caps, most of the growth is probably behind them. So I would probably be coalescing around more of those mid caps, right?
Why do listener questions make InvestTalk better?
Which of these would you recommend?
Because each caller presents fresh questions in their voice.
When do I know the right time to take profits?
And listeners instinctively realize that InvestTalk uniquely offers a welcome dose of investing satisfaction.
I think you have a terrific show, and I've learned a whole lot.
So don't forget to call InvestTalk. 888-99-CHART.
Hi, Steve and Justin. This is James from New York. I have a general question about analyzing a company and their debt. What kind of metrics do you guys look at, or how do you analyze a company's long-term and short-term debts? How do you know that they have too much debt on their balance sheet or their debt is justified? Just wanted to know if there's any kind of quick ways to look into this. Looking forward to your answer on that. Thank you.
That's a very good question, and I'm starting to get impressed with the quality of questions from our audience, and I really appreciate that. So, how do you know if a company's carrying too much debt? Because it's very difficult. It's very difficult. For instance, first you have to have the understanding that some companies need debt to grow. They can't grow without debt, and banks always have debt, right? They're borrowing money and lending it out, so they'll always have huge debt. Then you got REITs; they always have huge debt. Then you have other companies that sometimes, one of the reasons why I don't like auto companies is they always carry a lot of debt. Generally speaking, they carry a lot of debt. Historically, they carry a lot of debt. And I never understood why they should. They also pay high dividends. To me, that makes no sense. You're borrowing money to pay dividends? So, that goes to part of the problem. If it's a company who's growing real fast, okay, it's going to have a lot of debt because its growth makes it have to buy more inventory, build more factories, do whatever it needs to do to keep up with the growth. Okay, so you can't just say, well, it has a lot of debt, I don't want it. No, how fast is it growing? If it's an old line company, been around forever, ever, and ever, and ever, and it's carrying lots of debt, that makes no sense unless it's a bank. Okay, unless they just recently bought another company and the debt borrowing money was cheaper than selling stock or issuing bonds. Wouldn't it be nice if I could just tell you a number? If it's more than 10% debt of their market cap, don't buy it. There's no such thing as that. That doesn't work. So this is not answering your question at all because it's almost virtually impossible to answer that question in a vacuum. I can't tell you. I can say stuff like most companies that are mid-size or large generally don't have a lot of debt or shouldn't have a lot of debt, unless there was a very good reason to have the debt and you need to find out what that reason is. Now, for instance, Apple, they have billions and billions and billions of dollars, and yet they borrowed money because it was an avoidance situation of taxes and to pay dividends to the. So, it's just not an answerable question in a vacuum. You've got to ask what company we're talking about, and then let's go look at the debt. Okay? Now, if you have a question about a stock or an IRA, college savings plan, well, maybe buying a house, mortgages, reverse mortgages, we're here for you. 888-99-CHART, 888-992-4278.
You're listening to an encore presentation of InvestTalk. Please call with your questions and comments, though, 888-99-CHART, 888-99-CHART, and Steve will answer them on the next InvestTalk.
Now let's go over to Boston, head over to the East Coast, and talk to Santos. He wants to talk about bond funds.
Yeah, thanks for taking the call. So I read an article on Morningstar about that bond funds are the way to go during the recession to diversify or to prevent the losses. So can I know what are the bond funds and where can I buy them?
Well, you can. There are hundreds, probably thousands of different bond funds that are out there. Now, which one you buy is depending on what your goals are. Do you want long duration bonds? Do you want short, mid, intermediate duration bonds? Do you want to take a lot of credit risk or not? So you can't paint bond funds with just a broad brush like that. Yes, certainly bond funds tend to outperform during tough economic times. Why? Because interest rates tend to drop and bond funds tend to appreciate. But that's not always the case. If, for example, right, Luke, a high yield bond fund, that's high risk. It's kind of a quasi equity, right? So it depends on what you're looking for. If you're looking for ultra safe, then you're going to want something more treasury like, right?
Yeah, and certainly if you're looking at where to buy bond funds, I mean, a lot of funds these days, bond funds, equity funds, you can just purchase on exchange. There's a lot of bond ETFs that are managed by PIMCO or Vanguard or any of these large asset managers that are allocating to a wide array of strategies, be it treasuries, high yield, junk bonds. So certainly there's a lot of options out there, and you can purchase them just like you would purchase any equity fund.
Yeah, and I wouldn't shy away from individual bonds, especially if you're buying treasuries. Treasuries, you can go to treasurydirect.gov.
There's no reason to pay somebody to buy you treasury.
Exactly. You can go do that yourself. But bonds can fit in a portfolio in this type of environment, but understand that not all bonds are created equal, and bond funds created equal.
Hey, Steve or Justin. I have kind of a personal financial question today. So I'm a 24-year-old teacher from Ohio, and I'm looking to go back to school to get my master's degree. It'll, in total, cost me about $25,000 over 2.5 years. So I'm looking how to pay for this further education, and I can only kind of find two ways to do it. I can't find ways in my own paycheck to pay for it, so I could either limit my 403B contributions, or I could take out a student loan for this. I'm currently putting $500 into my 403B, as well as putting money into my state pension retirement system for teachers. What would you guys recommend that I do? Either take out the loan, or should I just limit my contributions? Thanks, you guys. I'll listen to your answer on the podcast.
That's a very good and difficult question, because I love the fact that you're putting money away, being 24, putting money away for retirement. I love that. I also think it's wise to further educate yourself if you can earn more money in the future. With a master's degree, you should be able to do that. So make sure you measure the value of the master's degree. How much will it allow you to make in the future? How much more? If you're going to pay $25,000 for it, how much more will it allow you to earn? Everything being equal, and it makes sense, if it makes sense to get that master's because you'll make more money, what I would probably do, I'd probably split it down the middle. I would still contribute half of my $500, $250, and put aside the other $250 and borrow less money for the student loan. I think that's what I would do. Everything being equal, I really would like to sit down and pencil in how much money you're going to make with the Masters. How long will it take to make that $25,000 back, and include how long it's going to take me to make up money that I wouldn't put into my retirement account? How much money am I not putting in by getting the master's? I would be doing some hard math on that. And since you're getting the master's degrees, you're a pretty smart fella. You probably do that math. Good question, though. And I'm glad you're thinking about it, because I don't like that, but you're 24. If you're going to take it on, now's the time to do it. But at the same time, putting money away for your retirement when you're young has much more years to grow in the future. It's what makes it a tough question. Dennis in Oakland. How you doing, Dennis?
I'm doing great, Steve.
Thanks for the call.
I'm 65, and I'm putting some money in the Roth IRA for the next 2 years, like 24K, with my wife and I.
Okay.
And I think I should just do it. I don't need the money, so I think I should just put it in aggressive for the next 20 years, and then when I'm 85, then there'll be a nice nest egg, additional nest egg. What do you think of that idea?
If you don't need the money, I think it's a great idea.
Yeah, I don't need the money, so.
See, that's the key, because you're at retirement age, quote-unquote retirement age. If you don't need the money and you're willing to let it ride for a number of years, all that growth that the Roth grows for all those years, there's no tax consequence. Not one nickel.
You think the government might change their mind?
I don't think so. Think of the hue and cry that would cause, Dennis. No way. You and I, we'd be marching on Washington, wouldn't we? No, I don't think
we wouldn't be abused, yeah.
So I don't think they're going to change their rules on that. I really don't. There would be such a